foreign direct investment. The process by which a multinational will own and manage resources in more than one country. Most multinational investment, which comes from developed countries, is in other developed countries rather than in developing countries. Industrial multinationals provide a package. So the resources they're supplying is capital, skilled labor, technology, management, and access to markets. There are two main types of multinationals. There are multinationals who will use you, and multinationals who will marry you. A multinational that marries you is one who comes and establishes in your country to belong there and to sell to locals. A multinational that will use you is just coming for resources and is selling its product back in the whole country. Your interest in the host country is purely to exploit its resources versus I'm coming to stay and I want to be a part of your culture. The host country is the one that's receiving you. The host country will generally tell you the terms under which they will accept your investments. They have the right to say no to you, and they will not have you come and exploit them, in theory. Economics assumes that every decision maker is acting rationally and in his or her own self-interest. So if you are a host country, and a multinational is in your country, it's because you have invited it to come and reside there, or even to come and exploit you. But a company cannot force itself into your country, and therefore the invitation has to be made available. For a long time, countries that were anti-foreign investment would say, we will only receive it if you show that you care about us. In Latin America, there was a lot of anti-foreign investment sentiment. In many countries, there was anti-foreign investment sentiment. But the data showed that countries that received foreign investment did better than those that did not. So it turned the tide in favor of more of these countries that were anti-foreign investment to receiving foreign investment. Remember that when you are running a balance of payments deficit, you generally want money to flow into your country. And if you find yourself going cap, then say, well, here's what you need to do. You need to allow foreigners to invest in your country. Because what you need is a quick injection so you get the foreign resources you need to pay off your international debts. So the first thing to say is, have you considered inviting foreigners in? Under what conditions are foreigners knocking on your country's door to get in? You have something that's attractive. So you might beg them to come and they say, no, can't do, sorry, not interested. Many countries find that they're in that position. They want foreign investment to come and nothing comes. So at the end of the day, you have to be attractive to the foreign country. Either the size of your market is large enough so that the foreign company is interested, or you have the resources that they can exploit. Clearly. So let me summarize what I just said. Two types of FDI. There is market-oriented FDI, and there is resource-oriented FDI. One is coming because your market is attractive, and the other is coming because you have resources that you can exploit. The problem with resource-oriented FDI is that you usually are a beggar. You're saying, please come and exploit me. When it comes to market-oriented FDI, it's generally you're saying, I know you would like to stop exporting the product to my country and build a factory in my country to sell to my locals. You're coming to Brazil to sell to Brazilians, market-oriented. So you have to get on good terms with the government and let them say, well, sure, we will receive you. Usually, in many developing countries, there's a lot of anti-foreign investment rhetoric. A lot of that has changed, and usually changes when you need an injection. It changes the culture, because if local business persons figure, hey, this is an opportunity I can exploit, and a foreign company comes and says, hey, I want that opportunity. Locals who are looking forward to growing up in that industry feel as though they are somehow disadvantaged. So I want to flip the script. I think we understand the resource-oriented. I call that exploiting your local resources. You say, come on, exploit me. I have this resource, usually labor, and I don't have enough capital to combine with it so that I can actually produce stuff. So can I borrow your capital? There are two ways to handle this, by the way. You can buy the capital internationally and combine it with your local resources so you can produce the product under local corporate identity. Or you can invite a foreign company to come immediately. So the question going through your mind right now is, when a country says, yes, please come and establish domicile in my country, versus can I get a loan for $100 million to buy the capital and establish the company as a Brazilian company? When you invite the foreigner to come, it must be because you believe that that's the fastest way to get the goal that you want. Of course, you can turn the tide on the foreign company after a while. You can say, sorry, you only came for 5 years, so you need to leave now. We've got all the knowledge we wanted out of you, and we're going to do this ourselves. That happens. Usually, in a world of globalized relations where you sign treaties, etc., you will not see that happening, because an American company that establishes in Brazil will say that the American government and the Brazilian government have to agree on the terms, and therefore a new government can't kick it out. Now remember, Fidel Castro did that in Cuba. A lot of the investments in Cuba were American investments. And then he took over and he basically said, you go, the resources belong to Cuba. And caused many people to be very angry over that. And many Cubans living in America believe that when Castros are all gone and Cuba becomes capitalist again, that they still have a right to their resources. This is a good enough story to spend a minute on. 1973, 1979. In both of those years, oil prices quadrupled. Think of the local country, thinking that these foreign oil companies are making a bucket load of money off a resource that belongs to Venezuela. They're saying, well, we don't think that you have the right to own this anymore, because if you're going to pay us a pittance and royalties, and you're going to keep all those profits, you're digging this resource out of Venezuelan soil. And therefore, do you have the right to exploit Venezuela? So there was generally a push. Once oil prices rose, the oil-producing countries felt as though they had more of a right to the resource. In the Middle East, they were being paid pennies because the sheikhs over there had no idea what this thing was. And then they realized this was valuable, and what tipped the scales in 1973, October 1973, was the Arab-Israeli War, when America sided with Israel, and the Arabs said to America and the West, get out of our oil fields, and we'll manage our oil ourselves. And they got rich over that. 79 again, OPEC worked to push the price back up. Somebody's going to get rich. Should the multinational get rich off of your resource, or should you have the right to get rich too? It's basically an exploitation relationship. Generally speaking, the governments are not idiots, but ignorant. If you are coming to me with a proposition that you have worked out, you know more about the proposition than I do. So you say, Professor Kappen, I have a deal for you. Guess who's going to benefit more from that deal? You've thought it out. You've picked on me because I'm a novice. And you're going to pick my pocket. You might give me the impression that I'm going to win. And I might win a penny, and you win $1 million. And both of us win, and say, hey, you're going to win. So the multinational company, when it comes to your country to court you, it generally has done all the calculations. And the recipient host country generally has to get suspicious because somebody is courting you. So you go to this person and you say, hey, I'm interested in dating you. You've already done the calculation. You've looked around the room and you picked up this person. And you catch them off guard. And you tell them nice things. You're so handsome. You're so smart. And while that's getting into the gray matter, you pick their pockets. Not that you would want it. You know what your goal is to exploit this person. Can't be trusted. Economics is motivated by the idea that all players are calculating all the time in their rational self-interest. When a company approaches a country to invest in that country, the company has done its homework. You're not going to invest in a country where you're going to make a loss, right? I mean, that's kind of dumb. You've done the calculation. The question is, will the host country also make a profit? Obviously, if they receive you, they have to have calculated that it's in their interest as well. The question now is the balance of the gains. Who wins more than who? And often, you don't win as the host country because you're operating in ignorance. When they sell you this idea, they haven't told you all of the contingencies. Now, here, you might actually make a loss here. They sell it as well as they could. That's how capitalism works. So again, two types of foreign direct investment. Investment that's coming to stay, and investment that's coming to exploit you. One is after your customers, your citizens as customers. The other is after your citizens for their skills, and the product is being sold back in the home country. So when an American company goes to Mexico, generally speaking, it's going for labor, or maybe some oil-related resource. Otherwise, it's going to sell to locals. There's some industries that clearly are coming for locals. The banking industry, for example. The banking industry can't come to exploit your cheap labor. So when an American bank establishes in Mexico, it's going to sell services. It's competing with Mexican banks. And you can see how the local corporations in that industry will be kind of anti the foreign company because they don't want the competition. Usually the competition is going to make them be more efficient, but they could also get hurt in the process. So imagine a local bank seeing an American bank come into the local market. The first thing it's going to say is, well, I guess we have to raise our payments on deposits and lower our costs on loans. Because the American bank coming in has to offer something to cause customers to leave their local bank and come to the American bank. Hey, it's American, let's go and bank for the American bank. No. So the American bank is going to offer a more attractive rate on deposits and a lower rate on loans. And hope that as it penetrates that market, it wins enough customers to make it worth its while. There are sufficient opportunities or experiences of American corporations, and I say American because it applies to what we're saying right now, going to another country, intending to penetrate the local market, and 2 years later saying, we need to pull out. So you might go for the local market. It sharpens the wits of the locals in that industry. And you help the local industry because you made it more competitive, but then you leave because you didn't actually make a profit. In financial services, since that turned out to be the largest location for American foreign investment, when we broke out the data by industry, we saw that U.S. investments abroad. Now this excludes banks. I guess this would be the banks, a small number, but I'll still make the point. American financial institutions penetrating foreign countries generally did that because they could not do more of their growth within the U.S. market. For those of you who have taken a class in money and banking, you know how the regulations work. If you don't know, I'll briefly tell you that in the 60s there was no interstate banking. So a Michigan bank could not have operations in Ohio. And the New York bank could have operations in Pennsylvania, but it could have operations in England and Brazil. You could be in your state and global. You could be in your state and another state because of the banking laws in America. They wanted banks to be local. That's part of what created the crisis in 1973, when the Arabs put their money in the New York banks. The New York banks said, gee, we can't lend this money in New York. We can't lend it in Ohio because there's no one. We can't lend it in Ohio because the law doesn't allow us to do that. There's no demand in New York because there's a recession. So we're going to look elsewhere. And I mentioned earlier, maybe they shouldn't have accepted the money, but what do you do when someone says you want to put money in your bank? You receive it and hope that you can lend it out. And you need to lend it out so that you can actually turn a profit. Because if you're paying a 5% return, you can't get a 6% on your loan of the money, then you're making a loss, especially if you can't lend out all of it. You're going to see how that quickly can become an unprofitable venture. That's what happened to the banks in the 70s, and that's why they gave the money to Latin America. They pretty much gave it to poor countries, saying, oh yeah, we know you'll pay back. And they didn't get paid back. So the banks got burned, and they said, no max, we're not going to do this again. When they did it again in 79, 80, begging people to take the money because the Arabs came back and put all that money back in Chase Manhattan and had over his manufacturers trust and Citicorp, Citibank. They felt, okay, we lend it to you but at a variable interest rate because we don't want to get burned by inflation. So they have to figure out how to handle that as they're going to receive the money. But what they did is the banks themselves had to go establish operations. So there are two ways to get this money loaned out in these other countries. One is that you send it through a third agency, or you go and you establish a bank in that country. And it's probably better that you establish a bank in Mexico. In Mexico would allow you to penetrate the system, or Brazil or Venezuela. So the American bank shows up and says, we'd like to open a branch here and hope that they can get enough customers. But you do sharpen the system there. You force people, other banks, to lower their interest rates because you're competing with them. Competition does that. And many of those American banks pulled out relatively quickly because they found they could not make a profit. Let me take that back. They found that they could make a larger profit elsewhere. It's an opportunity cost question. Is this the best place to invest our resources? And once the Latin American countries were failing, the financial stress test, so to speak, it wasn't called that in those days, but they were failing to pay their loans back. Those banks got burned. So sometimes they tell the story as though the banks got burned while they were in New York. But the banks were getting burned when they located elsewhere, because they went there to lend money to locals, and not to individuals, to corporations. But they got the promise of the government that the governments will back the loans if the companies could not pay the loans. And when the Mexican finance minister, Jesus da Silva Herzog, said, sorry, we can't pay, if you're not paying, it really became an issue. So again, there are two ways that Latin America got this money. It got the money because the American banks went there and tried to court a penny here and a penny there from individuals, or when they sent it through the International Monetary Fund in droves, and they got burned bigger in that regard. But you get a picture of how they got their monies into other countries, trying to penetrate the market. I think the financial industry example is easier to understand. Money's move faster in financial transactions. And then it's trying to build a plant, hire workers, build a product, hope the product is in demand, fastest return. So even though the number is small, you get the picture of how the FDI was occurring. But again, there was a lot of failure. Failure because the international markets were not favorable, and failure because there was enough pushback. If you don't win enough local customers, you failed. How long do you stay when you're failing? Again, use the dating analogy. So you've asked someone to marry you and they say no. You keep pestering them? And you say, oh, you're not giving up for me. And you move on. So the banks had to make a decision. Do we try to stay in this market that we don't understand? So when you go to a region where they speak a totally different language, it complicates things. You have to have your staff trained in exchange rates, because once we get past 1973, volatile exchange rates, I mean, there's just more risk in all of the investments. I would say that 1973 caused many American banks to pull back from their reach internationally. I know when I was growing up, there were lots of American banks. By 1974, they were all gone. Partly because the banks we had were British or Canadian. Being part of the British Commonwealth, they had easy access. When the American banks came, they lasted 4 years, and then they all dried up. Because once the exchange rate was volatile, then they had to calculate, boy, what is the risk of being in this particular country? So that complicated things a little. So what do we understand? What are the theories of foreign direct investment? It's also called direct foreign investment too, so it's DFI or FDI. I think FDI is the more popular term, but you can Google that. So we said they go with a package of resources. Look at how these corporations exist. Even when they're coming to produce in your country, the majority of the skilled workers might be expatriates coming from America, say, the upper level management. And then the plebs are locals. As you think through the politics of that situation, the internal politics, many of the locals will say, we never have a chance to rise above supervisor. We will never be a manager because we're not American. And you understand why the American corporation might decide we need the management to be American, so they know all the tricks of the trade, etc., as opposed to trying to get a Mexican to understand this and rise to the president of the corporation. We're going to try and keep the upper level positions with home country residents, which means the country has not only to be receptive to the capital that you're sending there, but also the influx of upper level management. As you think that through, it creates a bifurcated system, because the rich, and I'll say Americans again, the rich Americans at the top will have a higher standard of living and live in the exclusive subdivision that belong to the golf clubs and the other things. They'll have a different lifestyle than the people who work for them. And you can understand why many countries might say, well, we don't really want to receive foreign direct investment if it means that a class of people come in who are superior to our locals. If the locals can rise, and it's always smart to let one local rise, so you can say, hey, look, we have a local running this branch of the company. So the theories. They concentrate on the imperfection of the free market mechanism. And what that means is that If the free market mechanism worked, exporting would be the preferred option. You export to that country rather than you establish an operation there. But it's usually because the free market is not working. There are tariffs, there are other restrictions on imports, and therefore you're saying, you know what, if we want to get around these barriers, if it's tariff, they're called tariff walls. If we want to get around these tariff walls, then we need to go into that country and court the authorities locally to make sure we get the market for ourselves or get enough of the market. Some firms maximize growth rather than profits, subject to some profit constraint. I don't know if I should spend a lot of time on that. Generally, if you are a CEO, you're hired by a board of directors. The shareholders want you to give them the greatest return on investment. But if you're a high-flying CEO, you might say, well, I'm going to guarantee you 5%, and you let me do whatever I want to do. Let me shape the organization of my own. So the top-price CEOs don't do what the shareholders want to do. They tell them what they're going to do for them, and then they do what they want to do. So they have their own value set. Okay, we want to make your company green. And we believe that that's how we view ourselves. The green CEO. Now, after a while, the shareholders may get mad at you and kick you out. But in the meantime, you're basically saying, if you want me, you'll take me on my terms. And there are many CEOs who can do that because they are sufficiently successful and they can set their terms. This is not generally good economics, maximizing growth. But as a short-term strategy, you might say, if I can penetrate many markets quickly, and I mentioned that earlier, I might not make a large profit right now, but I preclude somebody else from coming into that market. And once the dust is settled, now I can pursue the goal of maximizing profits. So the question is, why FDI? My second point here is, due to technologies they don't want to transfer, they might set up a foreign subsidiary rather than exporting the product. Hopefully that makes sense too. If you have a local company receive your patents and your licenses and produce the product, then they can steal your technology. You can export the product, or you can hire a company locally to license your product and assemble it or produce it or distribute it. But you say, you know what, I don't trust anybody. I'm going to do it myself. And you've probably seen enough of those. Right here, for example, I have a computer, and the company that services on behalf of HP, but the company is not HP. They have a license. Likewise, you can imagine how a local company in Brazil might have an HP license. And they're the HP representative, but it's a Brazilian company. And the fear at some point is that the technology might be stolen or something compromised in some way. I don't want to transfer my technology. This is associated with difficulty in pricing specific assets or resources. So sometimes you don't actually have a price on a part of your process. So you are producing a product and you figure, let me send the parts to Mexico to have this product assembled. You don't have a price for the parts that you send to Mexico because there's no market for those. It's kind of like you're cooking. You're halfway through the meal. It has no real value there. Only you know the value. Nobody wants to buy a half-cooked meal. So you figure I have to take this to the very end of the process to get the ready good. So that's a terrible analogy, but hopefully you get it. There's no price available for that stage. So there's no market for this intermediate chip. Nobody's buying it. People are producing the entire product. It's like a half of a process. So because you can't price it, you just want to get more cheap labor to add to this thing to finish the product, then there's no value for it. So there's difficulty in pricing that part of the process. So you figure rather than creating a market there, where you have people buying and selling these half-baked products, so to speak, you're just going to go and finish the full process elsewhere. This is the trade barriers, the tariff walls, the penetrate barriers in foreign countries. They don't need to be tariffs. It could be quotas and embargoes. We don't want to import the product, sorry. So you go and you establish this economies of scale. Hopefully that makes sense to you. If it doesn't, it means rising average costs. As long as you are producing on this side of the minimum, you're operating under increasing average cost or diseconomies of scale. Let me extrapolate from that comment to say there are very few companies in the world that operate under increasing average costs. So if the demand for your product is such that you find that your marginal cost is higher than your average cost, two plants will be more profitable than one. That explains my comment that under diseconomies of scale, a foreign plant would be attractive. Strategic policy. A firm might forestall a rival from entering the market. You might get in there because you don't want somebody else to get in there. Strategic points. And my last point here is to support activities of other MNCs. So I'm going to ask you the question. If you establish a multinational in Brazil or Mexico, and you're there to support other multinationals, what industries might you be in? I kind of wrote the answer out. So a bank might support another organization, a manufacturing organization. So if your bank here is JP Morgan Chase and you go to Mexico, you might tell your bank, you need to follow me there. So enough American corporations go down to Mexico, enough of them are using Chase here. Chase will say, we need to establish a Mexican branch so we can continue to service. It's kind of like I think you get it. So the service industry organizations like banks, insurance companies, and others like that will follow their major clients into other markets. Then you go back in history, and you think of companies that moved to colonies to establish operations. Their banks usually went with them. So I told you my story. The banks in my country were British banks. It was a British colony. And the British owned the commerce, they owned the industry, they owned everything, and the banks were British banks. So that their banks follow them and service their loans and their finances, etc. in Barbados. Handle all their transactions. You might understand. It's kind of like having a personal banker. I'll follow you where you go because you're a rich person. Or personal trainer. I'll follow you around because you pay me enough. So that's why multinationals exist. I've given you 1, 2, 3, 4, 5. This should be 6. 6 reasons. So I've told you the reasons a multinational might want to go abroad. Let me tell you the reasons that a host country might not want to receive a multinational. If this sector is in the national interest, well, Mexico really doesn't want American oil companies, or the Middle East doesn't want American oil companies exploiting them by owning the oil resources and paying them pennies. So they will say, okay, we will not allow foreign investment in this particular industry. Generally, what you would have is borrowing. You can borrow the money to buy the machinery, the technology we need, rather than allowing a foreigner to invest. There's this mistrust of foreigners. You figure they know more, they'll trick us. Go back to 1973 and 1979. Let's kick the Americans and the Brits and the Dutch out of our oil industry because they side with Israel and they are against us, so why should they make profits off of us while they are fighting against us? Makes no sense. National interests. Beyond oil, you can think of other industries that might be in the national interest. Anything that the country believes is very important to it. It's going to say we don't want foreign investment. You get the main point, though. Not only are we saying the foreign company has access to your country, but you might also say, no, you can't have access to my country. That's the main point. So you might say, you can invest in my country, but there's some industries that are off limits. Now, when you go cap in hand to the International Monetary Fund, they will tell you, you need to sell this industry to some international company. So ordinarily, you would see that the industry is being sold exactly against the national interest because your need for international monetary funds to be injected into your system is greater. And you will do it with a lot of trepidation. You say, we really don't want to sell the local industry, but we are forced to because we can't seem to make it work. And sometimes you sell it because you figure selling it is actually in the national interest, even though people think it's not, because you can sell it for a high profit right now. Long term, you're going to be worse off. Mexico had a hard time recovering from what it did in 1982. Not only did Mexico have a hard time, all of Latin America had a hard time. Mexico sneezed and all of Latin America caught a cold. Because America viewed Latin America as bad boys for doing what they did by defaulting on these loans. So how do you fix that? What you need to say is we don't need American investments anymore in the future. But then when the International Monetary Fund came back to Mexico later in the 80s, when De La Madrid was the president of Mexico, to help the perspective of Mexico as a country that defaults, he had to change the regime. And therefore, the beginnings of NAFTA, the genesis of the NAFTA idea, is in the De La Madrid administration, when he pretty much had to make foreign investments into Mexico more attractive without restriction. Because the IMF said, if you want money in the future, you have to let foreigners invest in your country. So Mexican assets were selling for pennies on the dollar. You were taking huge losses selling the national assets because you needed that injection of capital. The National Monetary Fund will say, we will raise some money for you, but the money we can't raise, you have to take your local assets and sell them all because this is the money you need. So if you have something that you think is worth $100 million, and someone offers you $20 million for it, take the $20 million because you need the $20 million. You can't say, but it's worth $100 million. Sorry. Take what you can get. So we had this terrible crisis coming out of the reform.
What hope is there for a small country then?
Free markets. That's the salvation. Even if it hurts you, be competitive, get out there and let the rest of the world into your markets and let them do what they need to do, etc. Or grow strong very quickly so that you can say, hey, I don't need you. At the end of the day, the United Nations, I'm not against the United Nations, okay? We'll tell countries, if you want to play, you have to pay to play. And you have to abide by the rules that we have. Recently, the United Nations told my country to change its laws. It says, you're too conservative, change your laws. And the people said, no, we don't want to change your laws. I said, well, if you want to be part of the international community, you need to change your laws. So imagine that the United Nations can come into your country and say, change your laws. Bill Clinton, in his administration, thanks to many American multinationals that wanted to penetrate financial markets, I said this earlier, in third world countries, told those third world countries they need to change their laws and allow foreigners to invest. And these local economies had no idea what the foreigners were going to buy, what prices they were going to pay, and whether it was a good price. I have a friend, a farmer in Barbados. He has been offered millions and millions of dollars for his farm by multinationals who want to do different things in agriculture. I mean, people have offered to build hotels, golf courses. I mean, they come to him with plans. They say, you're sitting on this gold mine of wealth here. Please sell it to us. He continues to milk his goats by hand and go and do agricultural things from morning till night, rather than take this windfall of money, millions of dollars that's being offered to him. He's taking a stand that he's not going to sell out the national interest. Meanwhile, all of his neighbors have sold out. So he's looking like a fool, a poor guy, when he could be a multimillionaire. Because he's saying, oh, no, I'm a farmer. I'm not going to sell. So what do you say? I mean, there's the ethical dilemma. He wants to be a farmer. He doesn't want to be a rich guy sitting around with Cuban cigars with his feet up. He wants to be a farmer. And he thinks if he sells out, he will no longer be a farmer. And anyway. So locals will not sell when they think restrictions against foreign direct investment have been applied in sectors which are perceived to be in the national interest or where the domestic lobby is very strong. Enough locals are saying no to the foreign investment. So the local computer guys are saying, we don't want IBM coming in here because we will all lose our shirts. Or let me use another good analogy. They said, we don't want McDonald's. There's no McDonald's in Barbados. They said, no, McDonald's will close and they will come in and we will all die. So no McDonald's. Go to Barbados, sorry, there's no McDonald's. There's a segment I'm going to have you watch on the Jamaican McDonald's. There was a company in Jamaica called McDonald's, but it did not produce what McDonald's produces. McDonald's sued the company because it had the name McDonald's. So some guy named McDonald in Jamaica had his own restaurant. McDonald's said he was trying to write on their name. I'm selling Jamaican food. You're selling something else. So the Jamaican courts supported the Jamaican guy won the case because they said that McDonald's USA didn't have the right to come into Jamaica and tell him to close down his operation because they had the same name. You've seen companies with the same name in various parts of the world or even parts of America, same name, but they're different establishments. McDonald's said, you are writing on our name and therefore you need to shut down. McDonald's wasn't even present in Jamaica. They were saying, you can't use our name. He's saying, but it's my name too. Well, thankfully, the courts allowed him to win. But if an international court had heard that, they probably would have made him change his name. Because McDonald's argued that they had the right to this name all over the world. And when people heard the name McDonald's, they had a certain image. He was spoiling their reputation by running this ragtag operation. So it's just an example of how locals are afraid of being run out of business.